Hey guys, it's CJ Investing here, and today I'll be discussing 3 beaten down dividend stocks that are screaming buys in June. I thought this would be really intriguing, and I just want to give my thoughts and opinions on this article while I read it to y'all. So, a decent dividend plus a bargain price adds up to an incredible opportunity for investors to consider. If there's an upside to a down market, it's that not every company whose shares get punished will end up in the dustbin of history. As the market declines, quite often, great businesses with solid long-term prospects get put on sale, giving investors a chance to buy at great prices. When those businesses also pay supported, sustainable, and often growing dividends, then investors who buy the shares can get paid for their patience as they wait for recovery. To help figure out whether such opportunities are emerging in today's market, 3 investors in Fool.com contributors name beaten down dividend stocks that look like they can be screaming buys this June. They uncovered Stanley Black & Decker, SWK, Home Depot, ticker symbol HD, and 3M, MMM, that's ticker symbol. Eric said stocks don't get much more beaten down than tool makers Stanley Black & Decker. The company's stock has cratered by almost 40% so far in 2022, and its price is teasing its 1-year low. That's hardly fair. Stanley Black & Decker is a top name in the tools and associated goods space, and it has been for years. It owns some of the top tool brands you'll find in millions of Americans' closets and garages outside of 2 that comprise the company's name. It also sells the Craftsman and DeWalt lines among numerous others. Like many of the best stocks, Stanley Black & Decker has historically managed to consistently grow revenue at a bottom line profit. But this has been overshadowed lately by a notable increase in the cost of raw materials, a key input for the company. As a result, it recently cut its net profit and free cash flow guidance for the full year 2022, which sent investors scurrying for the exits. Never mind that in the first quarter, the company trounced the average analyst earnings estimate for the first quarter, or managed to increase revenue 20% year over year, thanks to, in no small part, to a clever and complementary acquisition of gardening equipment purveyor MTD. Stanley Black & Decker is doing what it can to cope with the increase in raw materials cost, notably raising prices for its products, but that crunch with raw materials won't last forever. And even while it does, the company will continue to operate in an environment where key business drivers like the frothy U.S. housing market should continue to improve. The recent investor exodus has left Stanley Black & Decker rather cheap on its valuations. It trades at a forward price to earnings ratio of less than 12 and a price to book value of barely above 1, rather low compared to other manufacturing stocks, or just stocks in general, to be honest. That's really a deal. I agree with that. Meanwhile, although 2022 probably won't be a banner year for the company, analysts are expecting a much sunnier 2023. Collectively, they are anticipating a nearly 17% per share increase in net earnings. Finally, a weekend share price means a meteor dividend yield. Stanley Black & Decker currently stands out at nearly 2.7%. A very attractive figure when matched not only against stocks in its sector, but also hollow grouping of dividend aristocrats that it's part of. So that's one to check out. Stanley Black & Decker is personally not my cup of tea, but I think y'all should check it out. I think it could be a pretty attractive stock to take a look at, or at least keep on your watch list. So the next one is Home Depot. Home Depot is the excellent business selling at a fair price after the sell-off. So this dude says it's one of his favorite beat down dividend stocks to buy. The company has a wild couple of years, starting with a surge in revenue at the pandemic's onset, followed by the slowing growth in recent quarters. However, investors' pessimism surrounding Home Depot's prospects as economies reopen is providing a lower price to potential investors. Indeed, Home Depot stock is down 28% from its highs. Short-term fluctuations aside, Home Depot has done an excellent job growing revenue, expanding profit margins, and raising earnings per share over the longer run. I agree. That's good news for the dividend investors because ultimately, dividends are paid out of earnings. Home Depot's revenue went from $75 billion to $151 billion in the previous decade. The operating profit margin expanded from 10.4% to 15.2% during that same time. It all flowed to the bottom line. It grew earnings per share at a compound annual rate of 20% over 10 years. That undoubtedly helped Home Depot raise its dividend payout from 1.16 in 2013 to 6.60 in 2022. That means income investors in 2013 who held their stocks are getting nearly 6 times the dividend they signed up for. Today's income investors can expect Home Depot to boost the dividend over the next decade as well. So that's just the chart. Let's go back. The fall in Home Depot stock has it trading at a fair valuation, a price to earnings ratio of 19 and price to free cash flow ratio of 28. Investors can never be faulted by paying a reasonable price for an excellent business. Home Depot is an outstanding beating down dividend stock to buy for those reasons. Okay, next one is an industrial titan whose legal troubles are keeping the shares down. So that would be 3M. So Chuck, industrial titan 3M, shares currently trade for substantially less than they did 5 years ago, in part due to ongoing legal and environmental costs associated with this business. Such costs are unfortunately common to many companies, especially ones with long histories of operations and broad-scale product lines that people rely on for things like health and safety. That softness in the shares offer investors a decent opportunity to buy a part of a world-class company at a reasonable price. 3M trades at around 15 times earnings trailing earnings and closer to 13 times its anticipated forward earnings. In addition, it shares for a 4% yield thanks to a dividend that has increased for 64 consecutive years, yet which only consumes around 62% of earnings. So that's surprising. They've been increasing it for that long, and they're barely paying over half their earnings to their shareholders. So that's rare. That means they're a dividend king in the stock market. Not a dividend aristocrat, but a dividend king, which means they've been paying for double that. So perhaps even better, analysts are expecting only modest earnings growth of around 6.6% annualized over the next 5 years or so. A growth rate like that gives investors a good reason to believe the company could keep up its trend of dividend increases over time. It also means the market doesn't have incredibly high expectations built in, which when combined with reasonable current valuation could help moderate the risk of further declines. Given further reason to believe in its future, 3M has strongly embedded culture of innovation. This is how the company that makes post-it notes and scotch tape can also make products as varied as N95 face masks and car repair kits. The culture of innovation means that while the future is never certain, there's a good chance 3M will find a way to adapt and thrive in it. I agree. They have a large variety of products, kind of like Johnson & Johnson does, Procter & Gamble, those type of companies. Good, stable companies. So you get paid for your patience. Stanley Black & Decker, Home Depot, and 3M are solid companies. By the way, I used to own 3M. And it's a great company. So the companies that look like they have the staying power to make it through this current down market and on to brighter days ahead, the market recent sell-off has made them available at reasonable prices, while their dividends offer investors cold, hard cash for their patience as they wait for the potential of a better future. All of these are great options, in my opinion, if you're looking for solid, stable companies that will pay you dividends and will continue to pay you dividends, and you don't have to worry about whether it goes up or down, because you know it's probably going to go back up because it's going to be around for many years to come, because they're dominating in their sectors. They're not going anywhere. So that's something to keep in mind, but still do your research. If there's an upside to a down market, it's that offers like this only tend to come around when those brighter days look like they're far away. Nobody really knows how long it would take for the market to recover, which it's already starting to recover as I'm recording this video. Like it's went up some, but getting paid decent and potentially growing dividends while you wait for that day to come certainly makes it much more palatable proposition. So decide for yourself which of these companies may deserve a spot in your portfolio and get yourself in a better spot to ride out the rockiness. Long-term investors don't shy away from rockiness. We invest whether the company is up or down. We'll continue to invest in recession. So these are some great companies to check out. I personally am not too interested in Stanley Black & Decker, but I might, who knows, I might add it to my watch list. I have Home Depot. I've already bought that. And maybe one day I add 3M back to my portfolio. I have that on my watch list currently. I think that's a really great option. But I hope you enjoyed this short video. Thank y'all for tuning in. I just want to say I appreciate y'all. I love y'all. And I hope y'all have a blessed rest of y'all day. All right, peace.